All right, so again, welcome back from the exam. So here we're starting on a brand new chapter, chapter 7. Okay, so chapter 7 is going to be all about perpetual inventory, right? So in this case, if you guys remember what merchandising inventory is, it's where we spend cash to obtain goods, and when we obtain goods we do something to them and convert them to sales, and then sales eventually comes back to us as cash, right? That's the purpose of this class, is that we're teaching you how a merchandising type of operations actually works, right? We need to purchase inventory, we need to sell the inventory, right? We're not producing the inventory, we're only purchasing and providing. So in this case, we're looking at any typical retail store or some kind of wholesale store. Okay. Now, again, we talked about what is going to be involved in the cost of goods sold, or just the cost of inventory. So once again, the definition is all cost it takes to get the asset to the store. Okay, so once again, that can include the selling price that you purchased it at, or purchase price, I'm sorry. So purchase price that you purchased the product for. Any sales tax, right? So if you are a business, you can sometimes be sales tax exempt, depending if you can prove some kind of business license, or that you are a legitimate business. Some, or if you have some kind of license, okay? Some businesses, even if they have that kind of license, they will charge you sales tax regardless. It just depends on what the company that you're buying your items from. So tax can be exempt, but tax can also be charged, okay? You also have shipping and handling, freight charges. If you need, special handling for fragile items, you may have to pay an extra cost on that. Any foreign costs, any storage fees, all of that are going to be under, the cost it takes to include, or also known as the cost of goods sold, which includes all the costs it takes to get the inventory asset to your store. Okay. Now, of course, we talked about the inventory tracking methods, right? We already talked about periodic, okay? So for today, we're going to take chapter 5 and 6, and we're going to put it on hold for a minute, okay? And what we're going to do here is we're going to now take a look and compare how chapter 7 and 8 is going to work, which is going to be dealing with perpetual inventory, okay? So for now, let's put periodic on the side and focus on perpetual, okay? So of course we know what the definition of perpetual is, right? It literally means constantly. So we're constantly updating our inventory at all times, okay? So every time we purchase inventory, we're going to update our inventory, right? Every time we sell our inventory, we're going to update our inventory. So in this case, we're keeping a really good close track record of when we purchase our inventory, so having inventory in, and when the inventory leaves and gets sold, right? We also going to keep a really close track of that. So that means no matter whether you do it daily, weekly, or even bi-weekly, or whatever monthly, that you want to keep track of your inventory, right? At any given point in time, you are able to know how much inventory that you have on hand at all times, okay? So that's the difference between periodic and perpetual, right? Where periodic, we don't care to keep track of what we sell, right? We wait till the end of the accounting period, someone goes down to the basement, they take a physical count, and that's how you determine how the cost of goods sold was. You had this much amount, and now when you sold it and you have this much left on hand, you assume that you sold the rest of the inventory. While periodic, you already know without having to go down to the basement to take a physical count, okay? Now, of course, it's ideal for you to go ahead and double check and do, a double check measurement where you go down and take a physical count anyway, just to double confirm that you do have this amount left on hand. right? Just so then you can, in case someone sells something and didn't record it, or if the owner took it or something like that, right? That's what you have to do anyway. You have to take a physical count anyway, but you should know the general amount of items you should have on inventory at all times. Okay? So, with that being said, if you're keeping track of all purchases and all sales, okay, that means this is the huge difference between periodic and perpetual. When we recognize purchasing inventory, right? Under periodic, we recognize it as an expense first, right? We recognize it as a mere expense to the company. And then once we do our physical count, that's where we do our conversion entry to enter in our inventory items and to calculate our cost of goods sold, right? In this case, what we're going to do here for perpetual inventory is everything's going to go straight into inventory. Okay? So we're going to record it as inventory immediately. Okay? So that means every time we sell something, where did we put our items? In inventory. So it's going to be taken out of inventory. So every time we purchase something, straight to inventory. Sell something, out of inventory. So that's the idea here is, in order to keep a really good track record, right, we need to have the items already under inventory, so then we know how much we have on hand at all times. Okay? So let's go ahead and take a look at our first example where we're talking about perpetual inventory purchases. Okay? So let's take a look. So again, here you have a sample example here where on July 1st, XYZ company purchased 100 toys costing $5.65 each from Toys U, okay? The freight, okay, cost is going to cost you $100, okay? Record this transaction, okay? Now, in this case, right, we're going to be introducing to what's called your inventory, right? If we know that everything is going to go straight into inventory, that means any extra cost, any freight, any shipping, any tax, any storage fees, anything that's going to be involved with the inventory, we're all going to shove it into one inventory account, okay? Now, in this case, right, I want to specify as well, because inventory could be a very broad account, right? In this case, if I don't know what the item is, well, then just throw it into inventory. But if I do know what the item is, so in this case, I bought toys, that's going to act as my inventory, right? I have inventory toys. And what I'm going to do is, since everything's going to go straight into my inventory, all costs that are related to my inventory are all going to go straight to the inventory account, then that's exactly what I'm going to do. I'm going to combine my purchase price with my freight, and I'm going to shove it all into my inventory account. So in this case, I have a total of $665 worth of inventory, and I'm going to place it all under inventory. Okay? All right? Any questions here?
No.
Okay, so again, no.
I have a
Yes.
question.
Go ahead.
Purchase means why you don't put the purchase expense, freight expense, and account payable or cash?
Because we're not learning periodic inventory anymore. We're learning perpetual. Perpetual, we have to put everything in inventory so we know how much we have inventory on hand at all times, right? It's another different type of method that we're keeping track of our inventory. So in this case, that's the difference between periodic and perpetual, right? Periodic, we must recognize purchase expense, freight expense. Perpetual, we only recognize the inventory account.
Thank you.
Okay? And because we don't need to associate the difference between all those extra costs, right? Because everything just goes straight into inventory. We only need to recognize that one account and that one account only. Okay. So again, we combine the purchase of 100 toys at $5.65 each, gives you a total of $5.65, plus the freight of $100 gives us a grand total of $665. Okay, and that is it. All right. So now moving on to 7.2. All right. Now, of course, when we talk about making purchases of perpetual inventory, we also need to remember that we also have the possibility to return or get an allowance, right? Because again, there's many reasons why we need to return a product, especially when we're purchasing it from a manufacturing company, right? Again, you are reselling these items out to to the public, right? It's basically the manufacturing's name. So if they send you broken items, right, you can't sell broken items. So in this case, you can request for any for any returns or any allowances here, because you're ultimately reselling these items at a higher price. Okay, so again, many vendors can accidentally ship you the wrong item. Okay, they can actually send you acts. They can things can be broken due to shipping. Things can be defective, right? Again, if a manufacturing company is producing like 10,000 units in a span of a couple of months, you can expect some of them are going to be defective. Okay, and of course, maybe you found a cheaper supplier, right, that has the same quality, but it's just cheaper, right? That's a reason why you can return. Or also, too, it could be completely customer service. So if this company is providing you really bad products, or they're just not doing their job to provide as a manufacturing company, like they're not giving you the quality, they're not giving you the service, that could be a definite reason why you don't want to do business with them. So you want to return the products and go somewhere else. Okay. But of course, right, manufacturing companies, right, or any of those kind of retail or wholesale companies, right, they want to keep your business, okay, because you are probably going to be purchasing their products in large quantities, right? You don't just go to a manufacturing company and purchase one item. You usually buy in bulk, and when you buy in bulk, right, usually that's where most of their price points are, or most of where their selling points are, right? That you're going to be one of those customers that's buying out their products. Okay, so they want to keep you as a customer. So how do they do that? They would either give you special discounts, they could even give you discounted prices, unlimited returns, and even a money back guarantee, right? Because they want to keep you as a customer, because you're buying a bulk or a big portion of their inventory or their items, right? Their products. Okay. So here we're gonna go ahead and practice another purchase first before we can actually associate the returns and allowance. Okay. So in this case, right, if on January 1st, you purchase 100 coffee mugs, on an account from Cuppies Co., and each cup cost you $1.25 each, and freight cost you $100. So let's go ahead and record this transaction. Okay, so how would we record this if we're using perpetual inventory?
Use mugs inventory or something like that.
Good. And what else?
and also use the accounts payable.
Okay, so what are going to be my amounts that I'm going to record?
$225.
$225. So in this case, everything goes straight into inventory, right? So that means the purchase price, the freight price, whatever it is, right? Cost, we're all going to put it into one account. Everything goes straight to inventory. So in this case, right? Good job. We recognize that we purchased coffee mugs, right? That's our inventory, right? It's the specific item. We know exactly what we're buying, okay? And because everything goes straight to inventory, right? This is what we're going to calculate. We're going to calculate those 100 items costing $1.25, and we're going to include the freight cost. So therefore, our total amount here is $225. Okay? Okay. Any questions? So then, what happens when I have to have a return or an allowance? Well, in this case, right, on January 5th, okay, you received your inventory items, okay, you received your cups, and you found that 10 of those coffee mugs were broken, okay, and of course you request for a full refund on those broken mugs, okay, and the vendor okay, and the vendor grants you a full refund. So record this transaction. Okay. Now in this case, right, here's also where the difference is. So how would you record this return?
Are you just using 1250 or are you using the whole amount?
In this case, I have 10 of those mugs, right?
Right. But are you doing it at 125 or are
Yes.
you doing it divided by the whole cost?
Can you return freight?
No, you can't.
No, you can't. So in this case, it'd be for the 125. So in this case, you said 1250. Now, what account am I going to record?
Account payable,
Account payable. Okay, what else?
and this is a debit side, and credit side it is a mug or inventory
Say what? Say
allowance retail.
um. Okay. Um. That's very specific. In this case, I don't. That's too specific. But anybody else? What do you think that we're going to be taking it out from?
Inventory.
You're going to take it right out of inventory because if you placed it originally in inventory, right, which is an asset, right? Therefore, you're going to take it directly out from inventory, okay? So as I've mentioned before, right? Every time we purchase something, straight into inventory. Every time we sell something or have to return something, it comes straight directly out from inventory. So in this case, my coffee mugs, right? If they were $1.25 each, right? Times 10 gives you $12.50. You're going to record it as if you're going to take it directly out from the inventory. Okay? Any questions here? There is no need for a contra account because in this case, we know exactly what we have and we place it into inventory anyway. Okay? It's not an expense, right? An expense, it's kind of hard to undo some expenses. Okay? So that's why we have to have a contra account. And in this case, I'm looking at an inventory asset account. Okay? Where I can debit and credit, and this one can always go back and forth between the debit and credit. You can always increase and decrease assets, right? Okay? They never close out or they never have a point where you have to create a contra account for any reason. Okay? So in this case, I would take it directly out from my inventory because that's where I placed them in the first place, right? They're not in my purchase expense account. They're in my inventory account. So how do I undo it or how do I take it out? You take it right directly out from inventory. Okay? Now again, here's another example here or scenario 2. Okay? If you're able to get a full refund, right? You are also able to take an allowance because again, many vendors want to keep you as a customer. So in this scenario here, right, on January 5th, when you received your mugs, right, you found that 25 of them were the wrong size. Okay? In this case, you requested a refund on these extra large coffee mugs, right? But the vendor convinced you somehow saying, hey, these extra large coffee mugs could be, you could still sell them at the end of the day. They're still in good condition, right? And because of that, right, the vendor's going to offer you a discount, right? Because they want to make sure, oh, I'm so sorry. We made our mistake on our end. If we want to fix it, right, how about we give you a discount off of those items? Okay? Because here we're trying to return them, right? But at the end of the day, the vendor is right? We can choose to accept it or we say, no, I want my money back. I want these exact cups. Okay? So in this case, right, the vendor is going to give you some kind of discount to reprimand their mistake. So in this case, they give you a 20% discount and you accept it. So how are we going to record this 20% discount off of 25 coffee mugs? Okay, assuming that each coffee mug costs you $1.25.
You would still gonna be using account payable and coffee mugs?
Good. All right. Yes, you would. That's correct. Now, how would you calculate the 20% discount?
Well, you're just gonna get the total from the 25 mugs and then times that with the 125 and then multiply the 20%.
Good.
That total.
So in this case, I already have the answer here. So in this case, your total is going to be $6.25 refund. Okay? And that's correct, right? Because we place it in inventory, you're going to take it directly out from inventory. Okay? And that's it for chapter 7.2. Okay? So of course, if you can purchase items and you can return items, right? You can also record purchase discounts, okay? Oftentimes, vendors will give you some incentives because when they, sell to you in bulk, right? That means, and they put it on an account, that means you owe them, close to maybe thousands of dollars, right? Now, in this case, right, with this type of ordeal where they offer you terms, which is an incentive to get their money back a lot quicker, right, they will in return give you a discount. So again, terms, right, 2%, 15, net 30 means if you pay within 15 days, you will receive a 2% discount. If not, you must pay in full within 30 days. Okay? So in this case, you have an incentive, right? If you pay within 15 days, the whole entire bill, you should be receiving a discount. Okay? So again, depending on what the products are, right, and how much you owe, that 2% discount may actually make a huge difference. Okay? And then on top of that, depending on what kind of company you are, if you can afford to make the payment right then and there within the 15 days, right? If your other priorities have been paid off already, okay, and you have the extra money, then you want to pay it off, then you could take advantage of this discount. Okay. So, of course, when we talk about terms, there are two different methods that we are looking at when it comes to recording the discount, right? You could choose net method or gross method. So same thing like periodic, except this time we're using perpetual inventory, right? The ideas are still the same. Under the net method, you're going to take the discount immediately. Okay, so so again, this is for businesses that pay bills left and right. And in this case, when they need to pay this bill, right? They're very good at managing their bills and they can afford it to make the payments right then and there. Versus if they're not quite sure that they have enough money, right? So usually mom and pop shops, right? They don't go for that because they have other priorities, right? So then the gross method would be more for startup companies, okay? Gross method is where you record it at regular price, and whenever you make the payment, then you record the discount afterwards, later, okay? So again, we saw this before, but this time this is perpetual inventory. Okay, so let's take a look here. Okay, if on February 1st you purchase a total of 100 coffee mugs on an account from Cuppy's Co. Okay, and of course, each cup costs you $1.25 each, and freight costs you $100, right? Terms are 5% 10 net 30. Record this transaction using perpetual inventory. So in this case, we're under the net method. So how am I going to record my inventory here? If I'm using the net method under perpetual inventory.
Again, you're gonna be using the inventory and accounts payable, and you're gonna calculate the 125 times 5%,
Okay. And what do you get from there?
and then with that discount, you subtract that from the 125.
Uh-huh. Okay, so then in this case, right, you're going to recognize whatever inventory that you have. But in this case, right, because we're using the net method, right, we're going to record at the discounted price because it's the net method, right? We're taking the discount immediately. So in this case, that's exactly what we're doing here. We're going to take the 125 times the 5% to get you $6.25 each, which then you take that out from 125 to get you a total of 118. Then you add the freight because, again, all costs go straight into inventory. So in this case, you're going to owe a total of $218.75 each. Okay? And of course, if you decide to pay within terms, so let's say you made a payment as of February 5th when you originally sold, you originally sold on February 1st and you had to pay it on February 9, which is within terms, right? Because they gave you 10 days. Okay? So therefore, you're going to record that you're going to make the payment for the already discounted price because you already calculated from the beginning. Okay? Straightforward. Now, what if you end up scenario 2, right? Let's say you didn't pay on the 9th. You end up missing the discount period and end up paying on the 15th of February. So, because you originally recorded at discounted price, how are you going to record this when you make a payment when you miss the discount period?
You would use accounts payable and inventory. Um,
Good.
Yeah.
Good. Because in this case, right? Because the item that I discounted was the inventory item, right? Because I end up losing that discount, I got to put it back into my inventory because now I'm paying for the inventory items at full price instead of the discounted price, right? So therefore, instead of since I wrote in my books that I owe 218, but in reality I missed the discount period. I have to add those $6.25 back into my inventory and make a payment for the full amount of $225. So good, right? You need to understand this one is the easiest one or easier out of the two because this one you're only using one account. Okay? So whether you made a return, you're going to take it out from inventory. You have an allowance, take it out from inventory. Discount, inventory. Okay? Straightforward. Only one account. Okay? And of course, let's talk about the gross method, right? If you have the same exact scenario, you're just going to record it at regular price. Okay? So in this case, I owe $225, right? And then when, let's say, for example, I make a payment on February 9, this is where I meet the terms. So therefore, I need to calculate how much that discount amount is. And now when you do that, right, you're going to take the discount out from your inventory and say, well, I'm going to pay you less because I earned the discount. And where am I going to take my discount out from? Directly out from inventory, okay, for the $6.25, okay? If not, and I decide to pay on the 15th as usual, I just pay for what I owe. So in this case, best rule of thumb here is as a startup company or a small business that's trying to get somewhere, always use the gross method because you never know if you even have enough money to even pay for those items to guarantee the terms, okay? Because you have much more priorities. But if you're been in business for a while and you've earned enough money, then of course you definitely will have enough money to make sure that you can get those terms and those discounts. Okay. Any questions in regards to 7.3 or just chapter 7.1 through 3 in general? Okay.
No.
Okay, so once again, we talked about what perpetual means. How do we record a purchase? Straightforward, right? If you have inventory items, you list the inventory item there in accounts payable or cash, however you paid for it, okay? Once again, the cost of inventory is going to be every cost, including every cost it takes to get the asset to the store. Once again, everything goes straight to inventory, so all costs, okay? Then we also talked about what happens when we have a returns and allowances. If you put everything in inventory, that means you're going to take everything out from inventory. Okay? And then same thing with the discount, right? Whether it's net versus gross, you're gonna record your net by taking the discount immediately. But under the gross method, you just record the original price until you pay for it. Okay? So straightforward, okay? So right now, what I'm going to do is, since it's 10:12, I'm going to go ahead and stop here and call break. When we come back from the break, we'll do the exercise and then continue on with the rest of chapter 7, okay?